Thanks for tuning into The Scoop. I hope we can continue to serve as an important source of information and entertainment during these unprecedented times. I want to take a minute to thank our sponsor, Bitstamp, before we get started with the episode. They're the original global cryptocurrency exchange. Since 2011, Bitstamp has been a cornerstone of the cryptocurrency industry and the preferred exchange for serious traders and investors, trusted by over 4 million customers, including top financial institutions. Bitstamp is built on professional-grade trading technology. Their platform is powered by a matching engine from Nasdaq, the global stock exchange, and their APIs are consistently recognized as the best in the industry. Bitstamp's advanced trading interface, TradeView, features live charting, deep analytical tools, and is available on web and mobile. You can download the Bitstamp app from the App Store or Google Play, or visit bitstamp.net/pro. to learn more and to start trading today. That's bitstamp.net/pro. Hello, everyone. Thanks for tuning into The Scoop. I'm your host, Frank Chaparro, and I am joined by my colleague, Ryan Todd. We have a very exciting and special episode for you today. We are joined by two podcasters in their own right, Bloomberg's Tracy Alloway and Joe Weisenthal. Today, the podcasters are indeed becoming the podcast-ees. Ryan and I are thrilled. We're both big fans of Odd Lots and like to think that we've taken a bit of inspiration from the great work you guys do. And Odd Lots is actually what made me think about the idea for this show, which is going to focus on how this crisis has been different from the 2008 financial crisis, from a markets perspective, obviously, but also a reporting perspective. It's something that Tracy has brought up on several episodes, harkening back on her early days at the Financial Times when you were reporting in the midst of the 2008 crisis. Serendipitously, and I'd like to hope that this was in preparation for coming on the show today, your latest episode released yesterday examined how this crisis is very much different from 2008. But before we dive into those different market dynamics, I thought it'd be worth pulling out a bit of history from both of you. We'll start with you, Tracy. When you talk about the 2008 crisis and your time at the FT, you note that reporters from the younger folks to the grayer haired reporters are all kind of relearning everything, and we're actually on a level playing field. When you talk about a level playing field, what do you mean by that?
Sure. So I became a sort of hardcore financial journalist in September 2008, which if you were going to make that transition, doing it in early September 2008 was basically the month that you wanted to do it in. And what I mean when I say that the playing field was sort of leveled is I think people just tend to forget nowadays that all the stuff we associate with the financial crisis of 2008, rating agencies, derivatives, sieves, synthetic CDOs, all that kind of structured finance, really technical stuff, people weren't that familiar with it as it was happening. Everyone was sort of learning in real time what those things actually were, and they certainly weren't familiar with the way those different products and those different pockets of the financial system were interacting with each other. So, for instance, the repo market played this really big role in the bank failures, and specifically the failure of Lehman. The repo market is where banks and other investors sort of lend out securities in order to get short-term financing. But it wasn't an obvious place for people to think about when it came to financial stress in 2008. Now, of course, having been through that experience, whenever we get a financial stress of some sort, everyone starts talking about the repo market. But I think in September 2008, that wasn't necessarily the case.
So when you look back, I think about my time reporting at BI, and I somehow became the Bitcoin expert whenever there was something related to Bitcoin being reported on. And even at the block, there's the banking expert, which would probably be Ryan, given that he worked at Deutsche Bank, or Larry Cermak being the exchange expert, so to speak. So when you think back on that time, I guess there was no repo expert at the FT. There was no maybe CDO, CDL expert. And that kind of made things difficult, or at least very interesting for everyone on the team.
Yeah, there were definitely market journalists who were starting to peer into those sort of dark corners of the financial system, but there was certainly no designated repo person, no designated structured finance or civ person, and there was certainly no one who was sort of charged with looking at all those things and seeing how they were affecting each other and sort of playing out. So that's what I mean when I say everyone was on a level playing field. All of this was pretty much brand new. We'd never seen a financial crisis like it before. And so if you came into it new, as I was in September 2008, you were pretty lucky because you could sort of learn what was going on while the stuff was happening. And especially the way that we were doing it, I was working on FT Alphaville, which was the FT's finance and markets blog at the time. We were able to basically publish instantaneously as stuff was happening. So we had a really big competitive advantage.
Yeah, definitely the pinnacle of financial blogging, even still. When you think about those times, what's the parallel today, right? What corner of reporting is now emerging that is sort of at the forefront, similar to the repo market reporters back in 2008?
Sure. So the weird thing about the crisis that we're seeing today is it definitely has shades of 2008, but at the same time, it's completely different. And what I mean by that is, for instance, if you look at all the emergency measures that the Federal Reserve has trotted out so far, they've basically reached into their 2008 toolkit and taken out a bunch of the stuff that they launched back then in 2008, 2009. Things like, the asset purchase programs, some of the repo market liquidity measures. These are all things that were first launched in 2008. And that's been enormously helpful for the financial system. So even though we see this really intense economic stress, we don't necessarily see the kind of financial stress that we saw back in 2008. So if you listen to the episode that we did with Adam Tooze recently, this is something that he was commenting on as well. Today's crisis is an economic one. It's not necessarily a crisis that is completely localized in the financial market and then kind of infects the broader economy, which is what we saw in 2008. I'm not saying there's never going to be any financial stress and that banks and other investors aren't going to encounter problems, but it's different in that respect to 2008 when we were, really worried about banks going under. I remember people taking out cash from their bank accounts because they were worried that the banks weren't going to open the next day. I don't think that's the case today, and that's largely because of the response from regulators like the Fed.
I think it's probably the most critical question or difference. The fact that that financial stress you're talking about didn't spill over and then grip the rest of the global economy. I think you put it in the podcast, Tracy, as this being more of an economic crisis and the problems on Wall Street seeming far less serious. And in a sense, most people aren't considering widespread banking issues or, a run on banks. I'll turn to Joe. Do you think when we talk about this not necessarily being a financial sector crisis in a sense, do you think that the problems on Wall Street that might exist right now are being overlooked versus we whine about the Fed and what it's doing? It seems to never be able to catch a break, but no one's thinking about, well, is Citigroup and JP Morgan well
Right.
positioned? Or if they are, it's definitely not the focus.
No, I see what you're saying. I mean, I think, Tracy's framing is correct and so far, sort of in part due to the nature of this crisis and also in part due to the very sort of fast actions of the Fed. There has not been a lot of concern about core financial infrastructure the way there was in the past. I think like there is a point where if the real economic situation were to continue to just deteriorate and if unemployment doesn't bounce back in some reasonable manner, you start to worry about much deeper credit losses, loan loss provisions, and so forth. But I think, at this point, it's not obvious what there will be. I think, the key thing is that the central banks around the world, the Fed, they're so, committed to keeping the plumbing going. The core infrastructure has been de-risked. I mean, one of the interesting things is sort of like post-crisis, Obviously, 2008, 2009, we had the bailouts. And then in early 2010, we had Dodd-Frank, a law designed in theory to prevent the bailouts that we had seen previously. And there is this sense that while like the overall risk in the system has not gone away per se, that it has been removed from sort of core deposit taking banking institutions. And there is some view now, and like knock on wood, because who knows even by the time all this comes out, but knock on wood, it does appear, and that is the consensus emerging, that to some extent, for better or worse, that risk has been moved away from banks as we typically refer to them.
Well, it was an interesting hot button issue with Lehman Brothers, right? Whether or not that could have been avoided, whether or not it was the smart thing for the financial system to not keep that afloat. And the banking system, because of the bailouts, became kind of the boogeyman, so to speak. And in this crisis, they're not so much the boogeyman. It's probably more of, a political situation where the fingers are being pointed at various sides of the aisle or various political parties or folks. And then the Fed, I think, is probably under fire the most, doing things that we've really never seen before in terms of purchasing junk bonds and really working with all the levers it has. When you think about who the boogeyman is in this crisis, who is it? Who's kind of the one that the ordinary folks across the country are maybe upset with, maybe think don't deserve what they're getting,
Right.
et cetera?
I mean, I think you're right that the nature of this is much more on the political side. So obviously, you have people that are angry that what was arguably a predictable public health catastrophe. Lots of people were warning about it in the middle of January, that our institutions whose purpose is to protect against these things did not seem to do a good job. So you look at the ongoing testing failures or the slow ramp up in testing or other preventative actions that might have been taken didn't happen. So there's anger about that, obviously. Then you look at sort of the pure economic crisis, and you look at the different measures that other countries have taken to stabilize their economies and prevent the sort of mass layoffs and mass unemployment that we're seeing. And I think there's frustration that our political class hasn't been able to do that. And then, of course, also, like, this is just an objectively miserable experience. Like, even if people are remain relatively well off, they've hung on to their jobs and so forth, there's a general unpleasantness. And so you see the ongoing questioning, well, what is the right approach? How hard should the lockdowns be? And I'm sure Tracy in Hong Kong, where they have far fewer cases than we do here, has different views. But, I was thinking about that when you asked Tracy, like, well, back in 2008, 2009, there were no real experts, right? Everyone was on a level playing field. And I think to some extent, that is the case now with respect to the public health aspect. Obviously, there are experts in public health, there are epidemiologists, but no one has really, especially at news operations, very few people have gone through the live fire drill, so to speak, of covering in a pandemic as it happened. There are some, but by and large, this is a pretty new thing for everyone. And so everyone is sort of learning in real time. Bloomberg and elsewhere, we have really great reporters who understand the public health system. But this is a new playing field, and this is a new thing for a lot of people who are now covering it in some respect.
Well, yeah, I mean, even my perspective of covering this crisis, thinking about how to frame it, right? Is it the coronavirus financial and health crisis? Is it the COVID-19 tied pandemic health crisis? Just the way you sort of report on that top line has been something that I've grappled with, and that's just, surface level, very basic stuff. I think talking about the fact that we're all working from home, right? I am in a corner of my sister's apartment in Rhode Island interviewing the Odd Lots team. I never would have thought that that would be the case, right? We're all not only relearning or learning things for the first time, we're also doing it completely separated and distant from each other. You and Tracy have been used to working together remotely for some time, but it's interesting to me if I was a reporter at a large shop like Bloomberg, or if I was back at Business Insider, not being sort of brother and sisters in arms next to my fellow journalists with, so and so at the terminal screaming, hey, let's get on this. It would be really, really weird and difficult. Like, Tracy, could you imagine covering '08 in your apartment?
No, I couldn't. 2008 was a pretty special time in the FT newsroom. I remember at one point they started bringing in this trolley every afternoon that was full of cakes just because people were so tired and exhausted from the constant news flow that they figured we all kind of needed a sugar pick-me-up. So that definitely helped. In the sort of coronavirus era, yes, we're all working from home, but I do think so much of the media right now and the sort of interactions that you have with readers and, in the case of Bloomberg, terminal clients as well, so many of those interactions are already online or on social media or through Twitter and various chat groups. It hasn't caused a huge change in workflow. We're clearly able to still talk to people, whether it's through Zoom calls or some other platform. But yeah, you do miss the camaraderie. You do have to make the extra effort to sort of reach out to your fellow reporters and editors and ask them for their views on a particular topic. And again, that's more important than ever, given that we're sort of dealing with a systemic crisis. If you're writing about one aspect of that crisis, you really need to get the perspectives from a wide variety of your colleagues who are covering other industries or other things in the system.
Yeah, I have to say, I definitely miss the office, and I miss the sort of natural banter that happens in an office. And usually over chat or over Zoom calls, there's sort of we try to be a little more economical with our discussions. But I've been actually surprised it's less disruptive than I would have guessed. The daily news flow, I have to say, it's easy for me to forget while I'm working throughout the day that all of my colleagues aren't actually together in an office somewhere, because a lot of the things in terms of story ideas, story percolation, and then editing, it's been weirdly smooth. I often forget that, when I want to say there's something out of our DC bureau, that they're not all there chatting about it. So I'm not that bullish long term on, working from home. And I think people should have some humility about making big predictions oh, we're all going to work from home, or we're all going to leave cities, or whatever it is. But it's been kind of smooth. It's been kind of weirdly easy. Not easy, but you know what I'm saying.
So short Zoom, basically.
Yeah, except Tracy and I record our podcast via Zoom. So
you have to be bullish there.
We have to be kind of bullish there.
Yeah, it's interesting. I guess another question I have when thinking about this crisis relative to the last one in terms of reporting, do you guys find yourselves when you're thinking of either podcast guests or writing about different subjects or stories, do you find that the headlines or the news that's breaking, whether it's, jobless claim numbers coming out, or the number of new cases being reported, or the most recent action by the Fed driving your reporting? Or are you sort of looking for things that are maybe being ignored and trying to bring them to the surface? Like, what does this action, how does that translate into various activities on trading desk or something? How does remote work, for instance, impact liquidity, even though that story isn't necessarily a breaking news headline or number? How do you sort of navigate the news flow, I guess, is the broader question, and then frame it?
Well, Joe might have a different response, but I think the answer is we sort of try to do both, at least on Odd Lots. And you'll notice that we've gone from a 1 episode per week publishing schedule to 2 episodes per week, just because of the sheer volume of news flow. And what we're trying to do in those episodes is to get a really good mix of guests who are talking about the big picture stuff, like employment or how this crisis is different to the 2008 crisis. But we're also trying to get some people in who are able to talk about some of the really technical sort of nitty-gritty stuff that's driving a lot of the headline action. So a good example for that, for instance, would be Josh Younger from JP Morgan. He's an analyst who's been writing some amazing stuff on the US Treasury market, in particular the liquidity issues, some of those being caused by having a bunch of traders working from home for the first time and never having done it before. We had him on to sort of talk about the high level stuff going on in the Treasury market, but also the little idiosyncratic technicalities that not many other people are really talking about at the moment.
One of the things that, we were talking about in the beginning was this idea that this crisis is obviously very different from 2008, 2009. This emerged more in the real economy and the health sphere, obviously, versus something that was endemic to the financial system. That being said, I do think that there were a lot of lessons that Tracy and I learned, and also lenses through now which we view everything, that are highly relevant. And so if you listen to a lot of our past episodes, there is a lot that relates to this sort of like broader idea of the concept of like interlocking balance sheets. And that's like a broad concept, but it's one that I think a lot of people really started exploring in 2008, 2009, or starting to understand the world through this very like monetary lens, that ultimately that my payments are Tracy's income and vice versa, and that when we all reach for cash at the same times, that has very significant consequences. This is an extremely useful place to start in understanding the economy. And so even though it's a different crisis, these are like ideas that Tracy and I have been like talking about and interested for years. It's not totally new. It's not like, okay, this is a different thing than 2009 and therefore we have to start a new thing. It's like, well, here are these like tools and frameworks that we've been talking about for years to discuss how the economy works, and they are extremely relevant. And so listening to someone like Josh Younger talk about liquidity and the difference between owning short-term bills and treasury bonds versus reserves, a lot of these sort of like repo market mechanics are once again back at the fore, just from a new angle. And so I think that, although it's new, and although there's a crazy amount of new news, literally, hence as Tracy mentioned, upping our production schedule, there are just a lot of things that we've talked about in the past that are suddenly extremely relevant to how to think about some of the economic and financial tensions emerging this time around.
I think as a listener, one of my favorite things about Odd Lots is this sibling teasing dynamic that often plays out. And Joe, I think it was a recent episode, but we lose track of time. You were teasing Tracy for saying that you guys had covered every factor or theme of this financial crisis. And Tracy, you said something to the effect of, well, hey, listen, I said major themes. We got to keep it to at least 10, I think was the number, or some arbitrary number. We could spend hours going through the 10 biggest themes of this crisis and of 2008 and the differences. But if you think of the major two themes, I guess, of this COVID-19 crisis, what are they? And maybe what were the major themes of '08?
Well, I'll start with like what I see is like the really big ones right now, and then Tracy can add to them. But to me, I see the completely unique phenomenon of how do you shut down an economy while keeping the financial system going is sort of like the huge inherent pickle, so to speak, that policymakers around the world find themselves into. I would say another huge theme, obviously, is everything relating to the Fed contributing to that, but also the immediate recognition by everyone that fiscal policy had to be a huge part of the mix to keep people's incomes up. And then I would say the inherent, like, all at onceness of the global tension. So the idea that we're seeing this division of economies. We had a good conversation with Brad Setzer recently about how, like, as part of that shutdown, we're seeing a sort of global retrenchment, sort of literal reverse integration, disintegration, the likes of which we've never seen before. Those to me feel like sort of the big themes we have to wrap our head around right now.
Yeah, I would totally agree with those two ones as the major two themes. So the first one being the sort of how do you bridge a gap in the economy where cash basically dries up completely for a month or a few months or maybe even longer. And then secondly, the policy response, where we do see policymakers reaching for fiscal stimulus, and also more talk about direct financing of deficits, debt monetization, and Joe will obviously know all about this, but that sort of relates to modern monetary theory as well. And you do see MMT starting to creep into the mainstream dialogue a little bit more. If I was going to add two more themes onto that, I would say there's the sort of question over who bears the credit risk in the financial system. So we see the Federal Reserve willing to step in and assume more and more of that. But then, of course, eventually we're going to get the question of, if the central bank starts to take losses on some of those investments, does it matter? Do people get mad at the sort of headline about the Fed losing money and, their taxpayer dollars funding that kind of loss? And also, there's a question of where risk resides in the system. So, for instance, a really interesting result of the 2008 financial crisis is that regulators started pushing high-risk stuff out of the banking system, away from deposit-taking institutions, and more towards investment firms, mutual funds, asset managers, and non-bank mortgage players as well. And now that's sort of coming back to haunt the system, right? So we're talking about non-bank mortgage servicers potentially having to get a bailout. And then just the other theme that I would point to is this idea of dollarization of the entire global economy. So Zoltan Pozar, another one of our guests, a strategist over at Credit Suisse, he often points out that the dollarization of the economy is sort of like a dollar payments supply chain in reverse. Everything is priced in dollars. And so when you get a major stoppage when it comes to cash flow, that basically equates to a shortage of dollars in the system. And we're really seeing that at the moment. And again, that kind of ties into what the Fed is doing. The Fed has been very, very focused on providing dollar liquidity around the world. And again, that's the kind of thing where you could see some public backlash at some point.
That we're having this part of the conversation reveals to me why this whole trolling existed in the first place, because just listening to Tracy talk about that opens up all kinds of other thoughts that I have. But I do think,
it totally does.
Speaking to the fans of the Scoop and readers of the blog and people who are primarily in the crypto world, what Tracy brings up is, I think, one of the big things, which is that the dollar has never been hotter. Like, people think about, the dollar's falling and they're printing so much more of it and it's failing. What we're witnessing is the problem of that the dollar's refusal to go away, and that everybody wants dollars. And that, again, speaking to sort of themes that we started exploring after the last crisis, post 2009, is that not only did the dollar not lose its dominance then, it just got more and more and more popular. And it was clear that there were no good global alternatives, and so many different countries and companies around the world either borrowed in dollars or transacted in dollars. And that is the challenge for the global economy, is not what if the dollar goes away or disappears, but what if the dollar doesn't go away? What if it refuses to cede ground? And how will this world look as everyone sort of relies on the Fed? That's one of the big themes that's really emerging, is just the pure power of the Federal Reserve. We've seen, speaking of post-crisis tools, the reopening of swap lines so that foreign central banks could get access to dollar liquidity. The Fed has even gone further this time around, allowing foreign entities to repo their treasuries more easily to get dollar liquidity, which is sort of the swap lines on steroids. And so one of the big themes that emerges is exactly as Tracy said, just this: everyone all around the world loves and wants dollars.
I'll bring it up since you sort of alluded to it, the B word, Bitcoin, right? The thing that we focus the most on. This was supposed to be Bitcoin's moment for all intents and purposes, right? It emerged out of 2008. There were probably a lot of philosophical and economic reasons why it came to be at that time. And when people think about when Bitcoin is supposed to shine, or when it was supposed to break out or have its breakout moment, it would be during a financial crisis where things about the underlying economy or about the Federal Reserve System, about dollar hegemony would sort of be revealed, and investors would flock to this hedge against the current system. But what we've seen, right, is the almost exact opposite happen, right? And we tweet about this all the time at the block, much to the dismay of many of our followers and readers, is the fact that Bitcoin, for most of this crisis, right, has acted in lockstep with the stock market, U.S. equities, and we joke about it sort of being a S&P future over the weekend. When we look at how Bitcoin's moving, we somehow or in some way get a sense of how the stock market will behave that next day at the open. When we think about Bitcoin, have you been surprised, Joe, at how it's behaved during this crisis? And when you look forward, what does Bitcoin need to do to sort of live up to what Bitcoiners love about it so much?
I mean, it is striking. I'm looking at a chart right now on my terminal, a 6-month chart of Bitcoin versus S&P futures. They are different y-axes, obviously different scale. Bitcoin is more volatile, but the charts just look shockingly similar. So it has been this sort of very highly correlated asset, very high beta. And it is a cliche that in a crisis, particularly like liquidity crisis, all correlations go to 1. And so what that means is when you're running out of money and your bills are due, and that bill could be anything, whether it's a mortgage payment or rent or some sort of financial obligation, you pick up anything that's not nailed down and you sell it for cash. And that could right now mean stocks, that could mean gold, that could mean Bitcoin, that could mean any other sort of liquid instrument. So I'm not too surprised in a sense that we have seen this correlation. I think that like my view about the crisis and some of the potential for Bitcoin is one thing that makes Bitcoin distinct as an asset is this idea of sort of privacy, censorship resistant, sort of means of making payments that aren't necessarily allowed by authorities. And although Bitcoin hasn't particularly thrived during the financial convulsions, I do think that the post-coronavirus crisis period could really bring out some very interesting debates that emerge about privacy and about the degree of government monitoring of our activities, of course, because part of the track and trace is going to be, a new perhaps use of monitoring our phones to see where we've been and the people that we were encountered with. So I do think there is going to be a privacy narrative that emerges out of this particular crisis. So while Bitcoin itself may not have done anything special during the liquidity phase of the crisis, thinking about how we're tracked and monitored in the post-crisis period could create new narratives in which there is, I think, more potential for people to see the value in a monetary system or a payment system that works outside of the official channels. And then I think things could get more interesting. And then it sort of no longer just be a high beta market liquidity play.
Mm-hmm. Well, one of those ongoing or upcoming ideological battles that you wrote about this morning was sort of between modern monetary theory and Bitcoin. You called out Balaji.
Yeah.
Aside from his trolling, you do see some issues with his framing.
So I don't think like people, it's like there's a lot of like within the Bitcoin world, a lot of criticism of modern monetary theory. It's like, oh, these are just Keynesian centralizers who want central planners and stuff like that. And I don't really buy the idea that they stand apart from each other because one of them is a form of money, Bitcoin, while the other one is an attempt to explain the world and maybe offer up policy ideas. So they're not really like oppositional the way people imagine them. But I do think that they both provide a sort of blueprint for new ideas and how they emerge to the world. So the point that I was trying to make is that even though they're very different categories of things, they both have some things in common. So it's like Bitcoin, you have like the core.
Well, they both came about at the same time. I mean, in terms of interest.
So they both like really started taking off over the last decade. But the other thing is they both have been memed into popularity, right? So it's like you have core developers in Bitcoin who are like serious cryptographers and computer scientists working on hard problems. And then a bunch of people like posting memes that are just basically like, we see them all day. And any financial reporter, their Twitter account is inundated with like Bitcoin memes. Bitcoin solves this, whatever. MMT is kind of similar. It's like there's like this academic community at a few universities, like University of Missouri, Kansas City, or University of Massachusetts, Amherst, stuff like that, where people are sort of working on like unorthodox monetary papers. But then a lot of people are just like sort of memeing, whether it's like mint the coin, which sort of like sprung out of the MMT movement, or other sort of like arguments that people get into Twitter about how to talk about debt and deficits. There's a real parallel in terms of like how these ideas became things, so to speak. And I do think there's like a blueprint, sort of like we should all look out for them. Like, what's going to be the next Bitcoin? What's going to be the next MMT? Sort of look for areas in which you have this sort of like handshake meme between the people on Twitter who can put everything into a slogan and the people at universities and researchers doing like really serious work. I think there's like some interesting co-evolutionary parallels that are really worth paying attention to, even if the two ideas are not per se in conflict.
It's an interesting point, and it kind of speaks to my next question, which is in '08, you saw all of these effects of the crisis or consequences of the crisis trigger new ideas, whether it's MMT, Bitcoin, or just a fervor against the banking system that really cascaded across not only Capitol Hill and across the country and resulted in Dodd-Frank, more intense regulation around banking, kind of declawing the banks, so to speak. So many consequences, and we could get into them for hours. When you think about this crisis, what do you think will be some of the things to come out of it in terms of when we think about maybe politics or economics? What will be some of the long lasting ideas, political action that could emerge from this crisis, do you think?
Tracy, I feel like you should answer first because in Hong Kong, you guys are closer to the light at the end of the tunnel than we are.
Yeah, that's a good point. Tracy, what's different and what conversations are being had about changing the system that maybe weren't being had 6 months ago?
Sure. Well, I have to be a little bit careful in Hong Kong when, whenever you talk about changing the system, because we had the mass protests last year, and that's about really changing the system. I will say one of the surreal things of this entire crisis has been watching what was happening in China and Hong Kong and some other parts of Asia in January, February, and then seeing the exact same thing or a very similar thing start to creep up in Europe and then the US. I mean, I remember looking at the TomTom traffic data for Shanghai and Beijing in January and February and seeing it just fall off a cliff as the lockdown started. And then when Italy started getting cases, we were doing the exact same thing and looking up the TomTom data for cities in northern Italy and seeing it fall away as well. So there's sort of a predictable pattern that develops as the outbreaks circle the world. I will say the one thing that I could really see a lot of focus turning to once the dust sort of settles, at least in the US, is this concept of a social safety net, which is still really lacking. And also, I guess, on a grander scale, the purpose of capitalism. That sounds really sort of grandiose, but I think there are people who are going to be asking, what's the point of saving the economy or trying to keep the economy going if the result is a quality of life or a standard of living that's not actually that good? I mean, the whole point of having a good economy and aiming for economic growth is ultimately to better the lives of people. And if that's not happening, I think we might actually get some revision of what's going on.
Yeah. Well, that's a really interesting point. When you think about when the dust settled after the '08 financial crisis, it really resulted in more regulation on the banks, declawing the banks, trying to check their power. They were viewed as these behemoths, almost villain type actors. When the dust settles after this crisis, Joe, do you think we're going to see, like Tracy's talking about, a emergence of UBI being taken more seriously, for instance, right? Like that was kind of what made Andrew Yang the meme of the 2020 Democratic presidential race. Now it's something that could actually happen.
I think there's two things, and I agree with that completely. I mean, I think there's two things that we're sort of learning. Is that one is that cash in people's pockets is obviously a good thing, which is one of these things that's obvious to everyone. We joke, it's obvious to everyone except economists, maybe, but that's a good thing. But one of the specific reasons I think why this crisis in particular could lead to a sort of emergence of an American-style UBI is we have a broken mechanism for giving people money. right? How many days did it take between when the CARES Act was passed in late March and when people actually got checks in their direct deposit account? And it's a one-off, took multiple weeks, and some people didn't get them and didn't wonder, and people like dealing with these like creaking overload state unemployment insurance systems, and they're going down because they weren't used to the load. What we've discovered in this crisis is how bad our tools are for doing something really simple like giving people money. Like that should be, there are a lot of things in economics that are very complicated. Figuring out how to like get durable growth in an economy, figuring out how to raise productivity and so forth, figuring out an optimal tax code is difficult. Giving people money should not be difficult. And we're discovering that it is, and that we have a hard time with it, or companies that applied for payroll protection. Part of the infrastructure that we might, if we're wise, choose to build is a robust infrastructure for just monetary transfers, so that if the government passes a law that says everyone can get $1,000, that it's in their bank account tomorrow, or that they get a check tomorrow, and not something that takes 3 weeks to do. It's like, we got to build the pipes. And then what you could do theoretically is you could have a basic income that expands over time. So maybe in a normal period, everyone in every house gets, I don't know, Yang said $1,000 for adult, or maybe $500 per everyone in the family, including children, whatever it is. And then in a crisis, all it would take is, okay, we vote for the duration of this crisis to increase that to $2,000 per person, or whatever it is. But if we've already built the infrastructure to make the payment, then we can raise and lower that all the time, or then we can fiddle with it. Or in this hard, if a hurricane hits Florida specifically, just have it go to people in Florida, whatever it is. But I think we are discovering that we need to build those pipes one way or another, improve the infrastructure of giving people money, because we see that it's a powerful tool. There's a lot of economic theory that we've talked about on the show. Claudia Sam, who used to work at the Fed, has done a lot of work on this, that giving people money is a good thing. And we just have a very inefficient way of doing it. So I do think that could be a sort of like thinking about what infrastructure do we build? Why don't we just build a really good way to do that?
Just to add to what Joe was saying, in the beginning of the show, we were talking about the response from the Federal Reserve and how what they did was basically pull a bunch of, 2008 programs off the shelf and reactivate them. Yep. One of the reasons that Fed was able to respond to the crisis so quickly is because it had those pipes and those programs sort of ready to go. And I think that's a key difference in 2020 versus 2008. We're able to funnel liquidity and cash in some cases to the financial system and sort of to the corporate space. We're really not able to do it as efficiently or as well to individual people. And that's where the economic pain is probably greater.
And maybe that's the big learning from this crisis, right? Yeah. We were able to serve the banks and Wall Street, but not necessarily Main Street with the current pipes and plumbing.
Exactly right. And I do think earlier on you asked about like who is going to be the boogeyman of this crisis. I do think that's part of it, which is that I think Jay Powell and the Fed genuinely recognize that one of the things we need to do is, quote, get money to Main Street. And they built this thing called a Main Street lending facility that's new. But there is sort of this institutional limit where the easiest thing for them to do is to either go through the banks or buy bonds. And of course, we as individuals don't have bonds to sell. And so if your main tool is buying bonds, then that does sort of naturally exclude anyone who doesn't have bonds to sell. And so like figuring out, it's like what we're going to build on so that we can, quote, buy bonds from individuals, whatever the equivalent to that is something that we should figure out how to build. The Fed does not seem optimized to do that right now.
And if this crisis doesn't hasten or expedite the government to revamp, recreate, restructure the financial pipes and plumbing to better serve Main Street, the initiatives we're seeing across the globe, maybe Libra, maybe what they're building in China, could add, heat to the fire in terms of really recreating the financial pipes and plumbing. I want to be respectful of Tracy's time since it is so late in Hong Kong and I've already kept you over my 10-minute promise, but I know Ryan has been quietly sitting in the background. He is a huge fan of Odd Lots. I think he's just a little gun shy, but he does have a question.
No, I've enjoyed being a fly on the wall for this conversation. A lot of interesting things have been said. I guess.
Thank you.
Ryan's
if
my
I could
quant,
throw one,
by the way.
I'm Frank's quant. I guess that's my role
Oh,
here.
nice.
I do have a selfish question. I guess I can throw in. We've talked earlier about this idea of a level playing field and getting up to speed and effectively covering and reporting on the crisis in '08. And we've also talked about how this crisis today has different flavors of past crises, but still distinct in its own right. You know, you see the word unprecedented thrown around a lot these days. But when you look at global market events over the past 8 weeks, there really are a lot of firsts in various corners of the market. So I guess my question is, as a researcher that follows markets, be that credit, equities, or even Bitcoin, I'm curious to hear more about each of your processes in digesting, say, the complexity of the world today. So like, what's your respective secret sauce in sifting through the noise?
Joe, you go first.
Okay, well, I was hoping you would go first. I mean, for me, like, I said it like after 2008, 2009, I like really started absorbing voraciously analyst sell side research. I wouldn't recommend it for anything related to Bitcoin because I don't think there's anyone still on the sell side or actually
that's where the block comes in.
Especially on the sell side.
That's our role.
Yeah, I don't think there's nowhere on the sell side that I think is reading for crypto stuff. No offense, but there were two things to me that like really helped from my learning from reading analyst research from the major banks like Goldman and so forth. One is just like the topics at hand. And, even though I don't in these days often don't agree with the framing, just like diving in, reading as much as you can from like all these people writing about the economy and central banks and currency markets in particular, things like that. But then also, I think and this is, I think, helped me in as a journalist. One of the really nice things I think about reading sell side research is their whole game, so to speak. I hate to use that word, but their whole game is like, how do you write things in a way that's respectful of readers' time and attention? And how do you sort of like write something that's both informative, but also gets people's attention? And so I think like reading that has both helped me understand all this stuff and also really helped me as a journalist who wants to be read and who wants to be listened to by serious professionals in the space, because I do think that is essentially the entire sell side approach is how do we become listened to and taken seriously by traders and investors. So sort of learning how they operate, it's a cliche these days, like data journalism, right? Everyone wants to put charts and stories and so forth. They've been doing that forever because they recognize that visuals and charts and so forth are a lot more useful often than a bunch of words. And so in terms of figuring out how to do media in a way that's good for professionals, I think they're sort of great people to read for inspiration.
Yeah, I would echo that on the sell side reports. And a lot of what they think about is sort of what the media thinks about when it comes to headlines or just framing a story and figuring out whether or not you have an original and interesting angle or whether you're stating the obvious and being really repetitive. So yeah, that's definitely a thing. I would also say in terms of the process for gathering information, social media is really useful nowadays, and not necessarily because you're able to talk to a bunch of different people, but I think it's really helpful to sort of develop your own line of thinking and just sort of think out loud on platforms like Twitter and develop a sort of body of work or a theory of work on social media that you can go back and refer to and sort of test your own theories in real time. It's kind of an iterative process. And it does mean that sometimes you throw stuff out that's not completely finished just yet. It's sort of a half-baked idea. But I do think that's really helpful when it comes to journalism nowadays.
All the smartest people are on Twitter. Like, it's just a fact. There's a few exceptions of people who are maybe like really like just sitting there studies and do work completely disconnected. But the quality of conversation is just phenomenal. It's just great. Like the number, like truly, who are light years ahead of like what a lot of the people you hear on other platforms, like with the work people are doing. It's fantastic.
Why aren't more sell side analysts on Twitter?
Because they're banks.
They're
their
too
bosses
boring.
don't let them. They're just under anonymous handles and they're just listening.
Fair.
Well, it's nice that they get some love given a lot of the pressure they've been under, whether
No,
it's
totally.
MiFID 2 or whatever happened. I'm sure any equity analyst listening will appreciate that love from you two. And I know Ryan
Yeah.
appreciates it because he was on that side of the house at DB. Well,
Oh, nice.
this was a really great conversation. I know it's great because my heart rate has been above 80 for most of it, which is on the high side for me. So many interesting topics, and I know you guys can relate to this. Every question could have been its own hour-long podcast.
Yeah.
So I appreciate both of your disciplined approach to answering the questions and your enthusiasm, and can't wait for the next Odd Lots.
Aw.
Thanks so much. This was really fun.
Yeah, it's fun to be on the other side of these.
Yeah.
Oh, it is. And I can tell that you guys, there's sort of like a pent-up energy and desire to kind of take everything you've sort of gleaned from the past few weeks in doing your jobs and just kind of putting it out there. It's definitely a valuable exercise. I'd like to give our sponsor Bitstamp a big thank you, the original global cryptocurrency exchange. Bitstamp is built for professional traders, yet intuitive enough for any investor. You can use Bitstamp's advanced trading interface, TradeView, to execute your strategy or instantly buy crypto in seconds when the opportunity strikes, all from your computer or mobile device. Bitstamp prides itself on delivering unmatched customer service with a human touch. Their global customer care team is available around the clock via telephone, email, and social media. When you contact them, you'll always speak to an actual person, not a bot. You can download the Bitstamp app from the App Store or Google Play, or visit bitstamp.net/pro to learn more and to start trading today. That's bitstamp.net/pro.